I don't know if it started yet. Ah, there we go. Okay. Great. Okay, so for recording purposes, I'm just going to go back so we can make sure we're on the same page. Yeah, so in terms of this masterclass, these are the areas we're covering. Learning in 5, 6, and 7 specifically for the exam. As I did say before, for your paper for the exam, it is learning units 1 to 7, but I'm only covering 5, 6, and 7 because that is the bulk of what you need to know, and that is what has not been tested as yet. There are a lot of topics, so we will go through all the principles of what's listed here. And then in terms of our application session, so looking at past paper questions, it will only be on key items. All right. So first one, like I said, is the dividend growth model from Learning in 5. So we've got two. There's constant growth, and then there is variable growth. In terms of the constant growth, it is the easier of the two formulas. What we're trying to do is we're trying to calculate the share value today using our expected dividend and the required rate of return. And when you're working with dividend growth model, your required rate of return is the cost of equity. When we are dealing with free cash flow and other valuation methods, we are looking at your WACC, your cost of capital. So it's important for you to differentiate so that you know with a dividend growth model, we only use cost of equity, and then other models, we use the WACC or cost of capital. Okay. Then we have dividend growth model, like I said, for variable growth. So the formula is a bit more complicated because what we are now trying to do is determine what our dividend is going to be like for a specific growth period. And then what we do is, or what we have is a terminal value or a dividend in the last year that then grows indefinitely. So we have the R, which is the required rate of return, which is still the cost of equity, and then we have G for the growth. There is a specific formula for the growth rate, which I will share with you today, because the question that we do, and there are some other questions in the past paper bank where you are needed or you are required to know that. There are a few things that I am showing you today that are not in the textbook. It's sort of implied, but not specifically stated. So we'll share those with you as well and make sure that you're all on the same page for that. Okay, then we have the free cash flow model. So this was already touched on in Learning Unit 2 when we had to do mixed stream of cash flows. What has happened in Learning Unit 5 is just they're giving us a formal formula to work with, and we're using growth rates. Again, the required rate of return. So yes.
See, this is like how masterclass is.
Sorry, say that again.
My mic unmuted.
No, it's not. I didn't hear the question. Could you repeat? Was that not meant to be? I don't know, Daniel, were you asking a question or was it just a comment?
Sorry, ma'am. I didn't realize my mic was unmuted. My bad.
It's okay. I didn't hear. Okay, that's fine. No stress. All right. All right, so with the cash flow model, so this required rate of return actually needs to change to be the cost of capital. But in essence, with our free cash flow model, we're trying to look at or work out what our value of the company is today, looking at a free cash flow. I will unpack this a bit more. Free cash flows, like I said, is featured in Learning Unit 2, is featured in Learning 5, is also a key component of Learning Unit 6, as well as Learning Unit 7. So we must understand how these work. Okay, then you've got the price earnings model. The formula is EPS times your price earnings ratio. So earnings per share times your price earnings ratio. I will unpack the different formulas for EPS and price earnings. The formulas do come from Financial Management 2A. So it is a bit of a revision from something that you've done last year or in previous years. But this is, in terms of the formula, quite a simple model. It's more the calculation of EPS and price earnings that can be a bit more tricky. Okay, then we have the book value model. So this is quite a simple model in terms of what we are trying to achieve is the net asset value of a company. We're trying to work out what is the net asset value. And the formula is total assets minus total liabilities less your intangible assets, which include your goodwill. So this is quite a simple model, as I said. And really what we just try and do is calculate the value of all our assets and liabilities and exclude our intangible assets. So it's not too difficult. So this is one of the methods that we will not go in detail in terms of the application, but there are examples in your textbook that will help you with this. Okay, same thing with the liquidation value model, also quite a simple approach. You're trying to also work out the value of a company, and we literally work out the net. Okay, so I'm just checking if I need to unmute or mute somebody. Good. All right, so with the liquidation value model, you're really just trying to work out what your market value of each of your assets and liabilities are. So it's quite a simplified approach, not very complicated. And this is also one of the aspects that I will not cover in terms of the past paper question, but there are questions in your textbook and there are other questions in the past papers that are available for this. Okay, so that concludes Learning Unit 5. I will go into the whiteboard after I've run through everything again and unpack each of the formulas just in a bit more details and also give you the additional formulas for some of the elements within a formula. All right, now in Learning Unit 6, we literally deal with 3 valuation methods. We've got payback period, we've got net present value, and we have the internal rate of return. So with payback period, you have 2 types. You can have an even stream of cash flow or uneven. For an even stream of cash flow, the formula is payback period is your initial investment over your annual cash flow. So it's quite a simplified formula. And this one is quite the simpler of the 2 methods. The mixed stream of cash flow is more complicated. If we go to the payback period formula for a mixed stream of cash flow, it is the year, so the actual year, and we will do a question on this so we can understand this method. So it's the year plus the last negative cash flow over your next year's cumulative cash flow. So with this method, we do need to work out what our cumulative cash flows are going to be, and then from there apply the formula. But like I said, I will go through a question that covers this so you can understand how it's applied. Okay, then we have the net present value, which is a mixed stream of cash flows. We have 2, mixed stream and even. Mixed stream is specifically in Learning Unit 6. So there is a formula. Of course, we have the table method as well as the calculator method, and you may choose whichever method you prefer. But, just so that you have an understanding, it's your initial investment. So your initial upfront investment plus the sum of all the cash flows present valued. This 1 plus R minus N comes from Learning Unit 2 in essence. And your discount rate is your WACC. Of course, the formula and calculating NPV ultimately isn't difficult. It's the cash flows and how we calculate Learning Unit 6 that makes it very, very difficult. So we will do a question today where we cover certain aspects of calculating cash flows. I will also run through that in a bit more detail in terms of what are the 3 elements of calculating cash flows, what are the items you need to include, exclude, etc. And then we'll also run through the tax implications because that can be very tricky given the fact that a lot of you would not have done tax yet. The tax module is only in 2nd semester, so it can be quite tricky. So we will go through that in quite a bit of detail. Okay, so the internal rate of return. So there is actually a formula in the textbook, but it's more what they call interpolation, where you have to guess a range and calculate. So in my view, that just takes a lot of time in the exam. So the best method is the financial calculator method, which we will run through. And that obviously in terms of Learning Unit 6, again, calculating internal rate of return is not a difficult piece. It's more getting you to the cash flows that is really, really difficult. All right, so that's learning unit 6. Although learning 6 only has 3 concepts, it is by far, in my view, the hardest learning unit because of the cash flow element. So we will spend quite a bit of time on that today. Then we have our break-even cash flow. This is from learning unit 7. So this is when we're trying to determine what cash flow is required to reach break-even. It is a manipulation of our NPV formula in essence. And really what we're just trying to do is, like I said, calculate what the break-even cash flow is. So there is a formula. Generally, we do use the formula. You can also use tables as well, which I'll run through. But this is quite a easy concept because you'll have the cash flows already, and the initial investment will normally be given to you as well. Okay. Then in terms of the other concepts in learning unit 7, you've also got what we call sensitivity analysis and other concepts. We've also got scenario analysis. Okay, so I do need to just update this. It's actually meant to say scenario analysis. I will just make sure the slides are updated. With sensitivity analysis, more just for you to understand, but scenario analysis is where we need to look at the best case and the worst case. So we'll just update that. And there is 2 things you need to understand. You need to understand the range, and then you need to understand how to calculate your net present value for even cash flows, which I'll go through now. So just in terms of your sensitivity or your analysis range, it's best case minus your worst case. Right. Then now we have our net present value of even cash flow. So this is when our cash flows are not mixed. They're the same. They repeat. So it's actually an annuity. It's an initial investment plus an annuity. So the formula is slightly different. This is not specifically stated in your textbook, but this is the formula when we have even cash flows and we want to calculate the net present value. There also is the table method and a calculator method too, which I'll also run through. So it is important when you tackle questions that you understand, is it an even cash flow or a mixed stream of cash flow? If you're using calculator method, it won't really differentiate really how you calculate. But if you're using table method or formula method, it does change. So just be wary of that. Okay, then we have what we call risk-adjusted discount rates, which in essence is a different version of the CAPM formula, where we take into account something called the risk index. So we'll just go through how this correlates to your CAPM. So CAPM is something that you would have already learned previously in another learning unit. So this is just to factor in specific risk in a specific risk index. So it can be asked, it can be incorporated into other aspects. So for example, if you have a learning unit 6 question, we can bring radar in. So just to understand the difference. It's not really a huge difference. It's just a different way of asking a discount rate that accounts for risk. Okay, then we have something called the reinvestment approach. There's no formula. There's just a specific method where we have to calculate what needs to be invested and make sure that the number of cash flows are even in terms of the period. So, there is a good example in the textbook. This I won't specifically cover in this session today because we won't have the time. But if there are any queries around this, you're more than welcome to reach out. There hasn't really been a past paper question on this approach either, or that I've seen in the last 2 years. But there is something in the textbook that can assist. Okay, then we have your annualized net present value. So really, this is just how we are able to compare 2 projects and get a net present value for a specific year. So there is a formula. There's also a financial table method, and there's also a formula method. So there are different ways to calculate this. Again, calculating the annualized net present value using the formula or the calculator or the table method is not difficult. What is difficult is getting to your cash flows. And that's where it can, again, be tricky or can be incorporated with a Learning Unit 6 question, which I will show you today, where you can bring a Learning Unit 6 question and then ask to have annualized net present value. All right. So then the last formula for Learning Unit 7 is your strategic net present value. So this is really just when you have options on a project. So an option could be the option to make the project bigger, or to expand it over different countries, or to get some kind of tax cut. It can be any kind of option. Normally what will happen is in a question, they will give you the value of the option and you just need to incorporate that. So it's called the strategic NPV or net present value because there are other things that you have to consider to determine whether the project is worthwhile. So it's not a difficult formula, but it's just something to look out in case there's an option that's included in your question. Okay, so I'm going to stop there. I'm going to see if there's any questions at this stage, but I am going to go into the formulas and the different methods, the table method, the calculator method, and breaking it down in a bit more detail on the whiteboard. Okay, so there's no questions at this stage. Good. Okay, so I'm just going to transfer to a different screen. Just give me a second. Okay, so please just confirm that you can see the whiteboard, the mural whiteboard. Perfect. Thank you. Okay, so what I've done here is like I've done in previous sessions, where I've just gone and unpacked the different formulas and the different methods. Again, with Learning Units 5, 6, and 7, generally speaking, it's not really they don't really prescribe to you to say use the formula method or use the table method or use the calculator method. You can choose which one best suits you. However, it is good for you to understand the different formulas, different methods, because you never know what could happen on the day. Maybe, I don't know, calculator doesn't work, or you forget it, whatever. At least you've got a backup option. And remember that not all formulas are included on your formula sheet. Again, I will share an example formula sheet for the exam, but again, not all formulas are there. So it is important that you know them. All right, so let's start with the dividend growth model, the constant growth. So as I've shown you before, it's PO is equal to D1 over K minus G, D1 being your expected dividend, K being the required rate of return, and G being your growth. Okay. Okay, so D1 is really not a difficult thing to calculate, because normally what they will tell you is they will give you a current year's dividend and then say that there's growth on it and therefore you need to just increase it. So it's not a difficult item. Normally it's given to you. So that's pretty much the easier part. Okay. What becomes complicated when we're dealing with dividend growth is your K, or your required rate of return. Okay, so your required rate of return is your cost of equity, but can come in any form. Okay, so as I have here, I've got the CAPM formula, and then I also have the cost of equity formula. Your cost of equity formula comes from your WACC. So when you're calculating WACC, you say the cost of equity plus the cost of debt gives you your WACC. So this is just an extract from your WACC. Really, that's all it is. So you need to know those formulas. So your formulas keep on creeping up again. What you've learned before comes back again. Okay, so this is our CAPM. Okay, remember when you're dealing with your weighting on the cost of equity, you can also be asked to calculate that. There's a formula where you say the weighting of your equity over the weighting of the total, which I'll also just write up here. But in essence, it comes from your WACC. Okay, so there's two ways your K can be given to you, or it can be just given to you, or you have to calculate it in two ways. And we will do a question where we actually go through that and see how would we calculate. Okay. The other formula that we need to know is your growth rate formula. Okay, so the growth rate formula, that's not specifically stated in your textbook. That. Okay, so with your growth rate formula, it's DN, so your dividend over the dividend at the beginning to the power of, so this is 1 over n. It's 1 divided by n and then minus 1. Okay, so we'll go through that with you today in a question, as I've said. So again, your growth rate isn't given to you. It doesn't, not that it isn't always given to you. Sometimes you have to calculate it, which means it can happen in any formula. So wherever you have a growth rate in any formula, and we are going to do two other formulas that have growth rates, you could be asked to calculate them. So just so that you do have those formulas and are able to answer that. All right, then we go to the dividend growth model for a variable growth. Okay, so here is the formula that I did show you already. So again, this is your dividend, or your most recent dividend, as they call it. We then have the G for our growth rate. Okay. So you'll see that our growth rate, I mean, you could calculate it, but no, sometimes they do give it to you as well. So they'll tell you that there's a growth rate for a period of 5 years. And then afterward, there's a growth rate that tends to just go into infinity. So that's why there's a G1 and a G2, because normally they are different. But you could be asked to calculate the growth rate for the 1 year, for the one. It can happen. Okay, we then have obviously our R, which is our required rate of return, and our required rate of return could be any of the two formulas that I've shown you, or they can just give it to you. Okay, but you need to be prepared for all of that. Okay, so it could be this, or it could be the other one. It could be CAPM. Okay, I'm going to try not to do too many arrows, otherwise it gets too messy. And then we have our DN plus 1. Okay, so what is critical is that when we are dealing with this dividend growth model, right, this first part of the formula is in essence the dividend growth over a specific period, and then we have what we call terminal growth. And this is a concept that repeats all the time. You'll have an initial period and then a terminal growth period. And then there's your initial growth period. Okay, so with your initial growth period, we're basically working out the present value of the dividend for each year. And then what we're doing here is we're calculating the dividend into infinity. So it's like an annuity type question. What is critical is that this DN plus 1, okay, this dividend, it is your last dividend increased for growth. So it's the last dividend of your initial growth period increased for growth. Very important. Well, I won't be able to cover that today, but it's something that you must know because it does come up. Okay. All right. We can also use the table method. So the first part is an initial growth period where we literally have our dividend times the present value factor for each year. Okay. We can also then say the last dividend. So the last dividend in the initial period plus growth divided by R minus G times your present value factor. We can also do that and add the two together, and that will give you your answer. Okay, you can also use the calculator method, which I'm not really a fan of using that for this type of question because it can get quite confusing. But in essence, you would put in your required rate of return, and then you would put in what your dividend is for each year after growth, making sure that this CFT is the same as your dm plus 1 over r minus g2. Okay. But like I said, I do prefer following the formula for this one because just then I'll make sure that I don't miss something, because with the cash flows, if I don't say dm plus 1 over r minus g for my last cash flow, I'm going to get the answer incorrect. All right. Let's just quickly go on to the free cash flow method. Before I go there, I just want to double check. There's no questions at this point. Just want to make sure. Okay, perfect. And then I just want to quickly plug in some power because I'm running out. If you can just give me a minute, I'm just going to quickly plug that in. I'll be back in a minute and then we'll continue. Just give me a minute. Eli. Okay, sorted. All right, so let's go through our free cash flow model. So there is a formula, but generally speaking, we do tend to go to the calculator method because that is the easiest. We would just list all our cash flows. But just so that you are aware, we have our free cash flow, so the sum of our free cash flow in each year divided by our required rate of the return for that year. And then we add it to, again, the terminal cash flow. So again, it's got the same concept as what we just did now. So if I go back to, we have our initial period.
Listen, bro, I'm rather just gonna join now. I'm not listening to this. No, fuck. My lecture is 3 hours long, bro. But I'm not listening.
Yeah, just stop that. All right. Then we the terminal. This is the terminal one. So like what we did here, terminal period. So you'll see that when we're dealing with cash flows, especially in 5, 6, and 7, it's all about what is your initial investment, what was your initial period, what was your terminal period. We talk about that a lot. Okay. Okay, and again, we've got G for growth, R for required rate of return. Okay, similar to what we had before. And again, we calculate. Okay, with the financial table method, we are saying the free cash flow for each year times the present value factor. And then we have the free cash flow. So very similar to what we do here with our dividend. We say the free cash flow plus growth divided by R minus G. Same as what we do here in our dividend times the present value factor. Okay, it means that also when we're dealing with our financial calculator method, your last cash flow, the CFT, must reflect this answer. Okay, so it means it requires a bit of calculation. Same thing when we did the dividend. Okay, I noted it, but I didn't draw it. It must equal that. Otherwise, you're not going to get the answer correct. So financial calculator is easier, but again, you've got to do some calc, especially in the last year for your terminal growth. All right. Then we've got our price earnings model. So our price earnings model formula is very simple. It's saying the value of each share, or the value of a share, is your earnings per share times your price earnings. Okay, so then just to recap in terms of what you would have covered when you were doing Financial Management 2A, there are two ways to calculate earnings per share. Okay, either you can say earnings divided by your number of shares, or you can say earnings per share is your dividend per share divided by your dividend payout ratio. Okay, so it's quite important that you know what this is. So we've got your dividend per share. Okay, also dividend per share is also calculated, or can be calculated. It isn't always given to you. Your dividend per share is your dividend divided by your number of shares. Also write that out. And your dividend payout ratio also has a formula too, if you want that as well, which I'll also just write out for you. Okay, so for your dividend per share, okay, let's do dividend payout first. So your dividend payout, okay, so if we're looking at our Financial Management 2A textbook or information from that time, okay, it's your dividend per share all over your earnings per share. That's what your dividend payout ratio is, okay? Okay, the other way that you can also calculate it is sometimes they give you the retention, so dividend retention. Make this smaller. Okay, so when I mean total rotation, I'm literally saying it's 100%, and basically there's a portion that is kept and not given out. So if we're thinking of earnings, we're keeping the earnings. It's called retained earnings, right? And we're not giving out. So it's the retained portion. So you'll see that sometimes in your question they'll say, we've retained 80%, etc. And then obviously the payout is the rest. Okay, I'm just checking if everyone's still with me. I know my connection just dropped. Everyone's still with me, right? Good. Okay. Mm. Okay. So if we're looking at something like 20%, we know that our dividend payout will be 80%, but we'll go through a question where we cover that. All right, then our price earnings ratio has a specific formula as well. Okay, when I say SP, I'm talking about the share price. So I'm saying share price over earnings per share. Okay, so there can be like this formula can be used, or they can give you a industry specific price earnings ratio and ask you to adjust it for the risk of the company, which is what we'll do in a question. So you need to know all these different pieces. It's all revision of what you would have done before. So yeah, we need to make sure that we know all of this. All right. Okay, we now have our book value model, which is net asset value, which equals total assets over minus total liabilities minus your intangible assets. Like I said, I'm not going to go through a question for these, but it's just more for you to understand what these all mean. So you've got total assets. Then your total liabilities. Intangible assets. All right, and then the last one for learning unit 5 is your liquidation value model, where we're looking at the value of the company and your net total market value. All right, any questions on learning unit 5 before I unpack learning unit 6 formulas with you? Okay, perfect. All right. Now with learning unit 6, as I said, it's the initial investments over your annual cash flow. So this formula is quite straightforward. Don't really need to unpack. You will get an investment value that you initially put into a project, and then there's an annual cash flow that you need to worry about. Okay, then we have our payback period with a mixed stream of cash flow. So this one was for even. This one is for mixed, right? Okay, so when we are dealing with the year here in this formula, this is the actual year. So what I mean by that is the year in which your last negative cash flow exists. Okay, so with this method, you have to do a table to determine what your cash flow is, your cumulative cash flow is for each year. And this year will be the last year that you have your negative cash flow. Okay, so this will be last year in which your cumulative cash flow is negative. Then you've got your last negative cash flow. So in your table, you would have identified which is the year that this is from, that you have a last negative cash flow. And that is the value that you put here, but you put it as an absolute value. So when I say absolute, I'm saying that you note it as a positive number. So it needs to be an absolute number. And then your next year's cumulative cash flow. So the year that you have your last negative cash flow, the next year's cash flow is what you put underneath here. But I will go through a question so you can see what I mean by that. Sometimes this formula isn't very clear as to what it needs to do. All right, then we have our net present value for a mixed stream of cash flow. So we know that this here is our initial investment. Okay, your initial investment is negative because you are paying into the project. Okay, and then here is what we would call the remaining cash flows that exist. Wouldn't call it terminal, but it's just the remaining cash flows that we have. Okay. Then with our financial table method, again, we have our initial investment. We then have each of our cash flows and multiply them by the present value factor. So this part of this actually comes from, in essence, learning unit 2. It's when we did a mixed stream of cash flows and we had to work out what the present value is. So that actually comes from learning unit 2. So it's just now all we're doing is we're adding an initial investment. That's all that we're doing. So it's nothing new, actually. And then with financial calculator method, you include the year, you include each of the cash flows, and then your NPV. This is if you're using the HP. If you are using Sharp, you would need to make sure that you actually inputting your cash flows in the data section, and that you then inputting the rate in and then NPV it. Okay, so there is a very specific way. The financial calculator guides were shared in as part of the first masterclass, so those are still available if you need them. And then with our internal rate of return, like I said, we don't use formula or table method. It's just too time consuming. So we use the calculator method. And with the calculator method, literally we list all our cash flows, making sure the initial investment is negative, and then we work out the interest. If you're dealing with the HP, it's as simple as this. Otherwise, if you're dealing with the Sharp, there's a bit more complications to it. You have to make sure that this is included in your data section. All right, any questions on that? Good. Okay, then we have our Learning Unit 7 formula, so the break-even cash flow. So as we said, this is our initial investment. We have our required rate of return, which is normally your WACC here because it's net present values or it's cash flows. And then we have to the negative n. Okay, it's quite important that it's negative n. We're dividing it by. Okay, so that's quite a simple formula. Then we have, so this is not our sensitivity analysis, but more our scenario analysis, which I will just fix. We have our scenario analysis range, which will be best case, less worst case. So that's just when they give you options to calculate the range. Very simple. Here we have our net present value of an even cash flow. This specific formula is not in your textbook. Obviously, you can use the calculator method where you just literally put in all the cash flows and NPV it, because in essence, it's an annuity. You can follow this method, or you can use the calculator doing the annuity method. You can also do that, but you can just repeat cash flows here. It's not an issue. But what is critical for this formula, or what's the difference from what you've done before, is really this part here, because what we are including here is a present value factor of an annuity. So because it's an even cash flow and it's repeating, we're basically saying it's an annuity. And that is a concept that we learned in Learning Unit 2. So this is in essence an ordinary annuity. Okay, so that is really the only difference when you're dealing with net present value of even cash flows. So it'll be your initial investment plus the cash flow times the annuity factor. So as you can see here in the financial table method, again, it's your initial investment plus the cash flow times the present value factor of our annuity. Okay. Right, then we have radar. So as I said at the beginning of the session, that I will show you the similarities. So you can see that radar and CAPM are very similar. Okay, so radar, CAPM are very similar. The only difference is we really take into account a risk index. Okay, so they're very similar. Obviously, RF and RF is the same. When you're dealing with a risk index, it's a similar item to your beta, because your beta shows the profiling of your company and how it moves in relation to the market. Your risk index is in essence the relating to that. Okay, so very similar concepts, but they will say to you there's a risk index. That's when you know that radar is being applied. Okay. And then we use WACC here instead of the market risk because we want it specific to a company and the company's risk. So WACC is used instead of the market return. We want to make sure it's company specific and risk specific. That's what's very critical here. It's risk specific. Okay. Okay. but just so that you can see, in essence, where it comes from. You would have done CAPM before. Radar and Learning Unit 7 is really just bringing in risk profiling. Okay. We've spoken about reinvestment approach, ANPV. We've spoken about that. This bottom piece of the formula is an annuity. It's the annuity factor. Okay, because now what's happening is we are calculating what is the amount that needs to be paid every year. Okay, so that's why when you're dealing with your calculator, we're in essence calculating your payment. How much is the repeated amount, the amount that you pay every year? So when we're dealing with financial calculator method for annualized net present value, this is the method we use. We have N, we have the present value, okay, which would be your NPV, your interest rate, and then we comp for PMT. And then the SNPV, or the strategic net present value, we did unpack that already. Okay. Any questions at this point before we start tackling some questions now? Okay. Right. So I'm going to bring up now our first question. So just give me a few minutes. Okay, so I want to just confirm that you can all see my screen. You should see a past paper question and then an Excel sheet. Okay, great. Okay, so we're going to start with this question. So this first question is a past paper question for Learning Unit 5. It tests both your PE ratio and your dividend growth model. So I will show you how those other formulas from that I showed you, the earnings per share and the price earnings ratio, etc. How does that come into play when we're dealing with this? Okay, so let's go through the paper. So the first thing we always do is we look at the marks. We know it's 20 marks. We know that it multiplied by 1.2 to give us how long it will take us. It should take us 24 minutes to complete. Again, when you're dealing with your question, you should always make sure that you are understanding what are the mark allocation, how long it will take you. All right. Then let's read the required. It says calculate the value of Robo Limited using the below business valuation models, and the investor's required rate of return is equal to the nominal rate of interest. Okay, so they're bringing some concepts from other learning units where we talk about the nominal rate of interest. When we're talking about the nominal rate of interest, we're saying that it includes inflation. Okay, so as part of the Test 2 Masterclass, we went over the common approximation, the Fisher formula, and there's where we include inflation for the nominal rate. So it's telling you here that you must factor in inflation. Okay, so that's what that means. And then the first one is we're going to do the dividend growth model. Sorry, the PE ratio. All right, so the first one is your PE ratio. The first thing that we always do when we're calculating is we write down what the formula is. Okay, so to remind ourselves of the formula, I'm just going to bring it up quickly. Actually, I'll just go to our whiteboard much quicker. Okay, so remember with our formulas, we are dealing with these formulas. So it's these ones here that we are dealing with. Okay, so that is the formula that we need to write down first. VO is equal to EPS times P over E, or price earnings ratio. Write this down. Okay, so now we look at what elements do we have. We have VO being the value share. We don't have that. EPS. Okay, well, before we do that, let's just go through all the details. So we've written down the formula. So it says, you're considering Invest Robo Limited, a company listed on the JSE. You have extracted the below information rates income for 2020 years. So you got the number of ordinary shares, great. Current share price, ex-dividend. Dividend per share. They've given us proposed retention ratio. Okay, so this is what I was telling you about, where they have a retention ratio when they're talking about the dividend payout. They're telling you how much they're retaining, what's your retained earnings. Then dividend per share they've given to you, equity beta, 1/4 of the market beta. Average industry PE ratio is 12. Your real rate of return is half of the inflation rate. Your inflation rate is 6, your risk premium is 5, and your number of years is 5. Okay, for your growth period. And this is a positive adjustment of 2 needs to be made to the industry PE ratio for company-specific risks. Okay, so now that we've going on to question 1.1, we have EPS times your price earnings ratio. First thing we need to calculate is EPS. So with EPS, remember there are two formulas. We either say it's our earnings divided by the number of shares, or we say it's EPS is equal to our dividend per share divided by dividend payout ratio. Okay, so we need to see what we have. All right, if we look at the information here, we have number of ordinary shares, great, but we don't have the earnings. They haven't told us what are the earnings for the year. Okay, so which means we can't actually use this formula. Okay, so we can't use that, right? With the next one that we have, we've got dividend per share, which they've given to us. So luckily for us, we didn't have to calculate it. And then the dividend payout ratio, they've given us the retention ratio, so we can work out what the dividend payout ratio is. So we're going to use the second formula. So this is the formula we're using, okay? Okay, so in terms of that, it means that we're going to say, cool, it's equal to our dividend per share, which is 12, divided by our dividend payout ratio, which, remember I said to you, it's the 100% minus the 80%. So just to remind you where I'm getting that from, remember we said about total retention minus the retained portion. Okay, so here in this question, they've literally told us that we're retaining 80%. So obviously the remaining is what we have. Okay, so remember, I must actually use the current dividend per share. Sorry about that. Okay, so there are two dividend per shares, your current, and they've got another one. You use only the current one because that's the one that's relevant for this year. Okay, let's make sure this is right. Good, 90. Excellent. Okay, so we're not done with this question yet. We still need to now, plug in this formula and complete. Okay, so it means that now we need to calculate that. And then we need to calculate our price earnings ratio. So with our price earnings ratio, okay, they said to us at the bottom here that a positive adjustment of 2 needs to be made to the industry PE ratio. So we know that the industry PE ratio is 12. We've got to do a positive adjustment of 2, which means we have to increase it by 2. Okay, so this is where I say to you that they can ask it in different ways. They could have asked us to calculate the PE ratio, but here they've actually just asked us to adjust. So it can be asked to you in different ways. This is one of the ways. Okay, so we know that our PE ratio is 12, and we're going to increase it by 2 because they said it's positive. Okay, which then gives us the 90 times 14. Okay, so our answer is then $14. And there's our answer. Okay, but we haven't answered the question yet, because what it's asked us to do, it says calculate the value of Robo Limited. When they say this, calculate the value of Robo Limited, they're asking you to calculate the value of a company. This VO is only per share. This 1260 is only per share. So for us to calculate the total value, okay, so total value of company. Okay, so when you calculate the total value of the company, we want to say value per share, which is the VO, times your number of shares. Okay, so please, with these kind of questions, when we're dealing with the dividend growth model, it's always about the value per share. Okay, it's different if it's free cash flow, but with this one, it is the value per share. So you've got to calculate what the value is for the entire company, must. Okay, so our value per share is the 1260. And we're multiplying by the number of shares which they've told us. So we're multiplying by the 750,000. Okay, so the value of our company is 945 million. Okay, so we've answered the question now. All right. Any questions with that one? Okay, so I see there's a bit of questions. Let me just respond to the questions. Okay, so to answer Keegan's question, will you upload these slides? Yes, I will upload them. I'll just fix the small little errors that I've made and make sure that they're right. For the table method, it was 4 years. Do you have to do the first part 4 times? That is correct. If we are dealing with a cash flow or a dividend, but remember there will be growth involved. Okay. So Scott's asking, can you calculate dividend growth on a financial calculating using the present value and future value? Yes, you may. It just means that you'll have to separate the question into 2 parts because you have a terminal value and then you have a dividend value. You can't combine the 2. Okay, so Blessing, I see asking about the calculator method. Would you just let me know which one you specifically? And then Blessing is asking me about adding the two. So it's with this question, why do we add the two? Because here it said a positive adjustment of 2 needs to be made to the industry price earning ratio for its company specific risks. Okay, so what's critical is when we're doing these questions, we are wanting to answer for the company because the question's asking us to calculate the value of Robo Limited. That is what it is asking us. Okay. Okay, I hope that answers your question there. I'm just also going to respond on the chat so that you have it as well. Okay, so the question is it possible that they don't give us number of shares? It is possible, but then they wouldn't want you to calculate the total value of a company. You would need to then just be calculating the value of per share. And also technically, if they don't give it to you, you could work it out backwards. If they say to you, earnings per share is X and the earnings is Y, you can work out the number of dividends. So that also can happen. You know, they can manipulate the questions and the way that you answer in any way. Really, they can. Okay, so let me just answer quickly to all of these. Whoa. Perfect. All right. Let's go on to the second part of the question. So the dividend growth model now. Okay. So what's important is we have to identify from this question, is it a constant growth period or is it a variable growth period? Okay. So how do we do that? How do we know which question it is? Okay. So basically how we know is because they've literally told you here the number of years or the growth period is 5. They've said it's, first of all, it's a set growth period. They've also said to you that there's only, well, they've given you information for only the current dividend and then your next dividend per share. There's no information about a terminal dividend. There's no information about a growth period into infinity. So this one is a constant growth model, not a variable one. That's how you would know. So that's what makes it tricky in the exam. Not so much answering the question, but identifying what it is they want you to do. Because here, it doesn't say to you which model. It just said dividend growth. It doesn't say if it's constant or variable. You've got to decide. All right, so now that we know that it's the constant growth model, just remind us which one it is. Okay, so it's this one here where we say P is equal to D1 over kg, and then we know that we can calculate the K, we can calculate the G, okay, the growth. All right, so we know that is the formula that we're dealing with. Okay, so let's make sure we write out the formula. Always do that first. Okay, the first thing is, do we have all the parts? So our D1 we know that it's the expected dividend, okay? What we mean by the expected dividend, it is the current dividend plus growth, okay? Do we have growth? No. So we've got to calculate. Do we have K? No. So we have to calculate it. How do we calculate K? Okay, the required rate of return. Okay, we know it has to be the cost of equity because we're dealing with dividends. Okay, so we know it's got to be that, which means it's either two things. Either we're going to use, like I said, your CAPM, or we're going to use the RE formula. All right, so let's see which one it is based on the information. Okay, so because we know we've got equity beta here, we have the real rate of return, we have inflation rate, we have risk premium. We know we're going to use the CAPM formula. So to calculate K, we're using CAPM. So we are saying R, like the formula here, RJ. Okay. Okay, so we know we've got that formula. So we've got RF plus BJ, RM minus RF. Great. So we've got the formula. Now we can answer for the question. Okay. What do we have? Okay, so our risk-free rate Okay, so we know we've got the required rate of return, which is the CAPM of RJ is equal to RF plus B times RM minus RF. Okay, but what we do need to look at is, do we have all the elements? Okay, so risk-free rate, we know that another term for risk-free rate is your real rate of return. Beta we have, but we don't, we've got the risk premium of 5, and we know that our real rate of return. Okay, so we can actually work that out. Okay, so our risk-free rate is the same as the real rate of return, which is half of our inflation rate. So it's 6 divided by 2 plus, okay, we've got our equity beta, which is 1/4 of the market beta. Okay, which we don't actually have that. So we don't have that. Okay, so that's an anomaly. We do have the risk premium, which is 5, which is basically the same as saying your RM minus your RF. Okay, Because we don't have the beta, we now need to look at a different formula for calculating our K. The formula we need to look at is the one that we worked out, like when I said, when you had the Fisher, when you had to take into account inflation, etc., etc. So that is what we've got to look at. So to remind ourselves of our Fisher formula, I'm just going to write it down now so that we have that. Okay, well, it'll be more the common approximation formula, right? Okay, so because we don't have our market beta to calculate equity beta, we have to use a different formula. Okay, so quite similar to what we had learned with our common approximation formula, where we take into account our real rate of interest plus inflation plus the risk premium. Okay, so in essence, what we've done is we've said RE is equal to RF plus RI plus RP. RE is then equal to the 6%, so which is our risk-free rate, divided by the 2. Okay, and why are we saying 2? Because we said half of inflation rate. We then take into account our inflation of 6 and then the risk premium of 5. Okay, so what does that give us? Okay, which is basically 14%. Okay, so we're not done with this question yet. We still got to continue. We've only done the K. What we need to do is now the growth. So to remind ourselves of the growth, here is our growth rate formula. This is the one. Okay. So our growth formula is dn1 to the power of dn to the power of 1 over 9 minus 1 over the DO. The DO is actually only underneath this part over here. Okay, so to calculate, we have to say what is our dividend and then calculate the N. All right, so okay, to remind us what our DN means. Okay. Okay, we need our current dividend. So DN is the current. So we've got to say 18. We then need the next expected year's dividend, which is the 12. Then we're going to all put that to the power of 1 divided by the N. The N here we know is 5. How do I know that? Because they've actually showed us here. And then we're going to minus that all by 1. Okay, so once we solve for that, we get 8.45%. Okay, now that we have all the pieces, we can now go back and calculate using the original formula. So we know okay, so we've got our dividend. So remember D1 is your current dividend increased for growth. Okay, that's what D1 means. So it means I have to take the 18, I have to multiply it by the growth rate. So I'm going to say 1.845. You say 1.80845 because I am wanting to increase it by the growth rate. I'm then going to divide that by, so I've got the 14 less the 0.8. I'm going to do it in decimals. Okay. And that will basically, if I were to plug that in, let's just make sure we calculate it. Okay, so we get an amount of 351,729. Okay, so if I just round that up, 35173. Okay, so the dividend growth model, we are saying that per share, it's 35,173. Again, because the question asked you to value the company, I need to go and calculate the total value of the company. Okay, so I have to say the value per share times the number of shares. So again, it's very similar to what I've done in the previous one, except we are replacing the answer with our answer above. And it gives us 263 million. Any questions on this question? Okay, so I see from the questions. All right, so let's see. Okay, so the question is for P value. Are we always trying to get the total value of the company? No, it depends on the question. In this question, they wanted the full value. They want the value of the company. So we have to calculate the total value of the company. If they just wanted the value of the share, then we just calculate the value of the share. You have to just see what the question asks. Okay. So for the sharp calculator, Blessing, there are guides that I shared with the first masterclass. I'll share them again for this one. It will show you what to do. Okay, so that will help you there. Okay, so Uzi, you're asking me from which year is this question taken? Are you asking, I'm assuming it's a 2023 past paper, what I can remember, but I think it's not the original ones. It's like the deferred ones. Okay. Then I see, let's see what else we've got here. Okay, how do we know it's a constant growth model in this particular question? So I did say that due to Okay, so because they're not really telling you about a terminal growth, because when you've got a variable, you've got to have an initial growth period and a terminal growth period. In here, there's no mention of a terminal growth period at all. So therefore, it means that that's not applicable. It means that it's a constant one. Okay, but that's a good question. It is difficult sometimes to know when it's constant or not constant. It's really difficult. Let's see what else is here. Okay. Okay, so Mustafa's question about using the market share price to calculate. Yeah, but you see, Mustafa, the current market share price that you're using is ex-dividend. It doesn't factor the dividend, so you can't use it. This is a value that's too low. It's missing the dividend in here, so you can't use it. So this was put in this question to trick anyone who wanted to calculate using a different way. So as soon as it says ex-dividend, it means that value is not the real current market share price. It doesn't show you the full value. That's why you would get a different amount. Okay, but that's a good question, because obviously if you know all the different methods, I mean, you might want to do it that way. Yes, you could say, you could just add your real rate to inflation. That would work, blessing. But just important to understand how you are calculating. Let's see who else. Is market beta always one? No, well, yeah, market beta is one, correct? And then your company one is then adjusted. Yeah, that's true. So you could actually do it that way. Yeah, this is correct. Yeah, Mark. So yes, there's lots of ways. So CAPM, cost of equity, cost of capital is whack because you've got to include debt and equity. Your CAPM only talks about equity generally. Cool. Okay, got it. You got it, Zander. Okay, so Blessing's asking where the calculator guide. So I have shared all calculator guides with all lecturers. So your lecturers are meant to have shared that with you already after the first masterclass. If they haven't shared that with you, I will request that that gets shared. Either it will be shared either centrally or by them. Okay. All right, let's see. Did I miss anything else? I just want to check. Cool. I see your comment, Scotty, and I ignore it. The failing one. Okay, so you've sorted. And then I see, okay. Please explain the growth rate formula. Okay, so the growth rate formula, Joel, is here on this whiteboard that I explained. It's basically your current dividend versus your next dividend to the power of 1 over n minus 1. It's also on the slide deck. Oh, it's not on the slide deck, but this is the formula for the growth model. So it's basically saying what is your current dividend versus your next dividend, how much is growing, and you're just calculating a percentage in essence there. I hope that answers the question. So I'm not raising it. So Eli, when you're saying, am I raising it to the power of 1? I'm not. I'm raising to the power of 1 over 5. If you see here, I've got 18 over 12 to the power of 1 over 5 because there's 5 years. So I hope that answers your question. Okay. Okay, so ask me, how did I get the risk index? It's not a risk index. It's basically, I'm saying it's inflation. So here I'm saying it's a risk-free rate plus inflation, plus the risk premium. So I'm basically, what I'm saying is it's the cap M, but we're saying that because we don't have the beta, we're going to look at inflation to help us understand what is affecting the value of the required rate of return. So it's very similar to the common approximation formula that we had in Learning Unit 4, where we said R plus I. And if you recall there, we actually had, it was R plus inflation plus risk premium. There was a question in Learning Unit 4 where we actually spoke about risk premium. If I recall that question from Learning Unit 4, yeah, it was question 4.2, where we basically said that our required rate of return from the common approximation formula is your nominal rate is equal to your risk-free rate plus inflation plus a risk premium. Okay, so this comes from Learning Unit 4 in essence. Okay. Okay, so that's what's difficult about this exam, right? Because you can mix. You see here, this is a Learning Unit 5 question, but we have CAPM, which was from before. We also have Common Approximation, which was from Learning Unit 4. And then there's EPS and everything in here, which is from, Financial Management 2A. So that's what makes it quite difficult. So I just want to check who is off mute. Okay. All right, let's go back to your questions. Okay. The risk premium. All right, cool. Okay, so there's a question about why we're dividing 6 by 2, because it did say here that our real rate of return, which is the fixed rate, is half of the inflation rate. Okay. Okay, so when we say real rate, we're saying there's no inflation, there's no risk in it. It's a risk-free rate. Okay, so you've got that. Yes. Cool. Okay, so I think I've answered everyone's questions. I think just Eli. Yes. Market beta is always 1. Okay. Alrighty. Okay, so that concludes our Learning Unit 5 question. Okay, so we need to move on to our next question, Learning Unit 6. Okay. Right, so let me close this. And let's go to Learning Unit 6 now. All right. Okay. All right, so learning unit 6, like I said, it's the hardest learning unit that we have because it asks us to calculate our cash flows as well as look at tax. So we'll unpack that a bit in this question. How would you structure it, and how would you answer it? All right. So first thing we do with this question is we look at marks. It's a 70 marker. It means it should take us 84 minutes, which is basically an hour and a half in essence to do this question. I'm going to try obviously finish it earlier because we must finish at 3 today. And I still got one more question that I'd like us to go through. All right, so first thing is 70. Now we look at the required. So it says 1.1, calculate the initial investment for the new machine together with the working capital requirement. Round off all calculation to 2 decimal places, and then calculate the income after tax for Club Limited. All right, so when we're dealing with learning unit 6, there are a lot of things we must know. Okay, so the first thing that we need to know is when we are dealing with cash flows, there are 3 parts. Okay, and if I actually should just get my little table. Okay, so obviously this question would have been much more marks if I had said to you calculate the net present value, because then I would have to calculate the cash flow for each year. I would then have to calculate the net present value, and then I would have to do all of these calculations. But what has happened here is they've just asked us for the initial investment only. Okay. Remember, when we're dealing with cash flows, especially with learning unit 6 type cash flows, there are 3 types of cash flows that we deal with. We deal with an initial investment, we deal with an operating cash flow, and we deal with a terminal cash flow. Okay. In this question, obviously, it's only asked us for initial, okay, but it's important that you do understand the 3 types of cash flow that can exist for you or that need to be calculated, okay? So when we're doing a free cash flow question or a net present value question with cash flows, often it will ask you to calculate all of these cash flows, the initial, the operating, and the each of which have different elements in it, okay? Just to run through it quickly, so not to really answer the question, but to actually just give you more a summary. So okay, so the principles of what we do with these cash flows. Okay, so a question will have various years. It really depends, right? I'm just saying that this one has 5 years. I mean, that's literally what I'm going to say. All right. So when you're trying to calculate your cash flows, it's always about your operating cash flow, like I said, your initial investment and your terminal cash flow. In your initial investment, it's either that we are purchasing a new asset, okay, or we are replacing an old asset. And then we have working capital requirements. These are normally the 3 elements that exist. Okay. When you purchase a new asset, it's like the initial investment that we have, with the question we're going to go through where we look at purchasing an asset. Then we have replacement of an old asset. This becomes tricky because we are now selling the old asset basically, and because of that there are tax implications. There's capital gains tax, and there's also other and recoupments that are part of when we sell it. I mean, I will go through it in this question, but those are tax. Then your working capital requirements is normally your initial investment, what you invest in, and we must know what working capital is. Working capital is your current assets less current liabilities. Okay, with your operating cash flows, we normally have either it will come in the form of contributions, but in essence, you need your net cash flows. So when I say cash flows, as the name says, it's only cash items. So we remove depreciation, we remove non-cash items. So it's a lot of our EVA concepts coming into this. Okay. The other thing we also have is working capital requirements as well. Okay. So we also have working capital requirements. So if you see in this question, they've asked you for the initial investment for the new machine together with the working capital requirements. So there's two parts to this question. They're asking you to give you this, your initial investment. They're then asking you to give this part of your operating. That is question 1.1 here. Okay. Right, then terminal cash flow, normally it is about, we sell the purchased asset normally. We normally do that. We sell the purchased asset. So it's normally a sale. We also get back our working capital. So we get back our working capital. So that's normally what happens. So these are the principles of Learning Unit 6 cash flows. It's actually principles that come from Learning Unit 1, so EVA, that have been brought into Learning Unit 2, that have then been brought into Learning Unit 5, because we had the free cash flow method, and now it's been brought into Learning Unit 6. So yeah, it's very important that we understand. And this is just the outlay. Once you've done your cash flow, what you're trying to do is you're trying to work out what is your net cash flow, and then you'll have a present value factor if you're doing it the table method to get your net present value. Okay, so that is how it can be done in a table method if you're using table method. Otherwise, what we do is you get your net cash flow and then you go into calculator method, right? So today I'm not doing a full question because it just would eat up all our time. I'm doing aspects of this kind of question. All right. Okay, so now that we've established, how would we tackle a cash flow question in principle? Let's go to the question, right? So we did talk about that we need to do the initial investments and then the working capital requirements for part 1. And then next we have to do the income tax after tax calc. Okay, right. So let's go to the top. It says Klopp Limited is looking to increase its production capacity in order to meet the forecasted demand for its product, soccer balls, which has seen an encouraging increase in sales as a result of the success of the national women's soccer team and upcoming Soccer World Cup. Quotes have been agreed for the new machine, and management has established that the cost of the machine would be 4.5 million from its preferred supplier. Delivery costs expected to be 300,000, and import duty expected to amount to 10% of the purchase cost. All right. So this initial paragraph is setting the scene for us. Okay, it's saying that we are going to purchase a new machine. Okay, the new machine is going to cost us 4.5 plus its delivery cost plus its import duties. In terms of accounting, we know that when we calculate the cost of an asset upon initial recognition, we need to take into account the full costs of that asset to bring it into its ability to be used. Okay, same principle applies in finance. When we're dealing with situations, we have to include all the costs that relate to bringing this asset into use. Okay, so these are accounting principles in essence being tested in a finance question. Right, then we go to the next part. It says the new machine has an annual production capacity of 80,000 units and is expected to be used for a period of 3 years, after which is expected to be sold at its estimated scrap value of 1.75 million. Okay, so they are giving us our production capacity for this new machine, and then it's going to be sold. So remember I said the sale of a purchased asset would be in the terminal cash flow portion, but this question hasn't asked us to do that, so we're not worrying about that. Okay, but we do need to worry about the production capacity because this question has asked about the income tax, and in order to calculate income tax, you need your profit before tax or contribution before tax, and we cannot do it without this. Okay. Right, next part. The existing machines have a production capacity of 120,000 units, so any excess demand will be met by the output of the new machine only. Okay, so this is a question where we have limitations. Okay, we know that the new machine will only produce 80,000. The old machine, or the machine that's there, produces 120,000. Okay. So we need to make sure we use our existing machine first, 120,000 units. Then we must use our new machine for the rest. So it means we've got to look at our demand. We've got to look at how many units we're producing. So it says here, management will provide you with the below demand and production of soccer balls over the next 3 years. Okay, so we know year 1 is 195, year 2, 205, 3 is 220. So you can see already that the number of units exceed the 120, which definitely means we'll need to use the new machine. Okay, so in a question, if you had to do a full-blown net present value question for this one, these calcs will all fall under our operating cash flow section and then a net cash flow section, okay, where we would have, what is our cash flow less tax? It's actually right there, net after tax cash flow. Yep. So this question is not asking us to do all this, asking us only to do the income tax. But in order to do the income tax, we still need to understand how many units are being produced. So this is still relevant for us. Okay. Then it says management estimates if the new product were to be sold to customers today, it will have a current selling price of 80 Rand per unit and a contribution ratio of 75%. That is variable cost is equal to 25% of the selling price. Okay. Price inflation is expected to be 10% per annum for sales and 5% per annum on variable costs. All right, so first of all, they ask, saying to us, we have a selling price per unit. Great. We know what the variable cost will be. Amazing, which means we can calculate net contribution. They've also told us that there's inflation, okay, 10% per annum for sales and 5% per annum on variable costs, okay, which means that we now need to factor in inflation for each year. Fixed overheads are anticipated to increase at 6% per annum each year from year 2 onwards. Okay, so they're also telling you that our fixed overheads are increasing, but only from year 2 onwards. Okay, so year 0 nothing, year 1 nothing, year 2 an increase. Okay, and fixed overheads are expected to amount 220,000 in the first year. So they tell you what your overheads are in the first year. And then it says, the manufacturing sale of the new product will give rise to an additional working capital requirement. Management has indicated that based on the historic trends of the company, the working capital requirement at the start of each year will equate to approximately 30% of total variable costs linked to the production from the new machine for that year. Okay, so this is a different way of calculating your working capital requirement. Normally what would happen is they would say to you that your working capital requirement is made up of these assets and liabilities. Here's your working capital. And then each year would be based on what is the inflationary increase. And we would then calculate the difference. Here now they're saying that it's 30% of the variable cost linked to the production of the new machine. So it means that we have to work out what our variable costs are with inflation and then take 30% of that for our working capital requirement. Okay, so it's a bit of a complication. And this is the difficulty with learning unit 6 questions, with learning unit 6 cash flows, is it can be asked in literally any way. So we have to read the question, we have to understand and make sure that we can answer it step by step. Okay, so additional information says Club Limited currently pays corporate tax 1 year in arrears. Okay, so what that means is that we will calculate the tax for a year, but it only gets paid in the following year. The current corporate tax rate is 28%. They must tell us that. We don't have to worry about VAT. Obviously, if there was VAT, we would exclude it. SARS currently permits a Section 12C capital allowance on new qualifying fixed asset additions over a 4-year period. So that's for our income tax calculation and for our CGT capital gains tax as well. And then a capital gains tax inclusion rate of 80% applies. So again, for capital gains tax, as I've said before, when we sell an asset, there will be capital gains tax, which is a separate tax. There will also be recoupments that we have to understand in terms of normal income tax. Okay, and then obviously there would be VAT. You'd have to take out VAT. So there's a lot of tax that can be thrown into a question. Then Club Limited use their WACC to appraise capital investment projects. The current WACC of the company has been calculated is at 6%. So we're very lucky, and that in this question we don't have to calculate WACC. It's been given to us. Okay. Another complexity is they can actually get you to calculate WACC, which again is normal WACC formula, or they could also throw in CAPM if they want to. really it can be asked in any way. All right. Now that we've gone through the details, before I tackle the question, I just want to double check if there are any questions. Okay, no questions. Okay, so let's tackle this question. The first thing it says is the initial investment. So it's basically this part that we're doing, right? I mean, that's in essence what I'm doing. The initial investment is normally only in year 0. Okay. And luckily for us, we are just purchasing a new machine. Okay, we are purchasing a new machine. We are not getting rid of an old machine, which is great because we don't have to worry about that. And then the only thing that we do have to do is the working capital requirements. That's the trick in this question, right? Okay, so for our initial investment, okay, I'm going to break it down into, oh, actually, let's leave it like that. Purchase of a new asset, replacement of old asset we are not doing. And then we have working capital requirements, which will require us to have a working. Okay. All right, perfect. Okay, so let's run through it. All right, so we've got purchasing of a new asset, okay? Normally you can just do a little calculation. I'm just going to note down all the different costs here just to help us. That is all. Obviously, if you did a little calculation, that would also be perfect. That would be completely acceptable. Okay, so the first thing that we have is the cost of the machine. Okay, cost of machine they told us is 4.5 million. So we write that in, got 4.5 million. Perfect. All right. Obviously, if it was inclusive of VAT, we would take out VAT. Please don't get tricked by that. Okay. Then we have delivery costs. Okay, we must include it, as I said, as part of the accounting principles. We must include any cost required to bring an asset to its ability to be used. Okay, so that's a principle that doesn't go away just because we are in finance. Right, then we have import duties. And with this question, they said that it's 10% of the purchase cost. Okay, the purchase cost specifically is the 4.5 million. Please don't add the delivery cost. The purchase cost is the cost of the machine. So we're saying the 4,500 times our 10%. Okay, so our machine okay, perfect. Okay, and because we know, well, our initial investment, because it's a purchase, we have to make sure that the value is negative when we're reflecting it in our cash flow item. Okay. Cool. Then we've also got to include our working capital requirements. All right, so the working capital requirements, we're going to have to do a separate calculation because it requires us to do quite a bit. I'm going to include the full grid because all right, so working capital requirements. All right, so let's remind ourselves of how we're calculating that. It says the working capital requirement at the start of each year will equate to approximately 30% of the total variable costs. All right, so for us to actually get there, we have to go through this whole piece in terms of the demand. Okay, so how do we start? We start and say, what is our demand? Our demand. Our demand in units. So we know that our demand is 195. We know that it's 205. And then we know that it's 220. Okay. Our demand in units. So I can just spell. All right, so our demand in units, okay? Then we need to look at our existing machine capacity. Okay, we know that our existing machine, the existing machine has a production capacity of 120,000 units. Okay, so we know. Okay, which means what is our capacity for our new machine? So new machine requirement, or let's say new machine capacity requirement. Okay, so we know from the new machine, okay, that is how many units we need. All right. Okay, but we know let me actually take out my extra years. Well, it's fine. Okay, so we know that our new machine capacity requirement is 75, 85, 100,000. However, we know that the new machine can only produce a certain amount. They can only produce 80,000 units. So it means that our new machine won't be able to do all of it. It is limited. Okay, obviously the 75,000 is fine. We can't do 85. It's too much. It only has 80,000. And then we know again for year 3, it is 80. Okay, so here what is happening is they are testing whether you understand limitations, whether you have to understand whether or not we can do more. Okay, so new machine actual capacity or limitation. Okay, so we can only produce that, nothing more. Okay, obviously if we had another machine, we'd be able to make it happen, but there's nothing else. This is all that it has. Okay. Perfect. All right. Now we can start calculating what our working capital requirements are. Okay. We know that our contribution ratio is 75%. Okay, so variable cost is equal to 25% of selling price. So we need to obviously include our selling price. We must, okay, because we have to calculate what our selling price is, and then, or what our variable costs are going to be, and then do that. Okay, so let's rather do that. Our variable costs per unit. Okay. So our variable cost per unit, if we have to calculate it in year 1, is going to be the 80 Rand per unit. So our calculation is going to be 80. Okay. Times the 25%, because we said only 25% of variable costs of the selling price is variable cost. And then what we're going to do with this is we're going to then say that that needs to be increased, okay, for inflation. Okay. What did we say that our 5% for variable cost? So we need to say times 1.05, or you can add 5%. So this is our calculation here. Okay, so it's 80 Rand times 25% times 1.05, which will give us 21. Okay. So this is our variable costs. Perfect. Okay, when we go to the following year, what do? Okay, we're now going to take our 21 and we're going to multiply it by inflation. Okay, which gives us 22 rounded up 22.05. And then for the third year, we're going to say it's 22 times 1.05 gives us 23. Okay, so now we can calculate total variable costs per unit, total variable cost, not per unit, total variable cost. How do we do that? We say it's our machine capacity multiply the 21. Okay. So we know that that is our total variable costs. Okay, what is our working capital requirement then? Okay, remember they said to us that our working capital requirement is 30% of total variable costs. Okay, so we're literally going to say 1.575 million times our 30%. Okay, to give us 472,500. Okay, so our annual capital requirement is that. Okay, but we need to know what is basically the increase, okay, the incremental. Okay, so to explain this, what it means is that when we're dealing with working capital, as I said, in the year 0, we have to show what our full investment is. Okay, so our full investment has to be what year 1's requirement is. Okay, and obviously because we're paying that in, it is a negative cash flow. Okay. Then for each year, we have to show the incremental. Those incrementals would go into this part here, the working capital requirement, but it's not a requirement for us for this question. They just asked us to calculate it as part of part 1, but we wouldn't need to put it into our operating cash flow because they haven't asked us to do the operating cash flow. Okay. So how would we do the incremental? We know that from year 1 to year 2, we need to invest the difference between the two. So it's literally the difference between year 1 and year 2's. And the reason why we're putting it in year 1 is because it's said to us at the start of the year. Okay, so what will happen is we know at the beginning of year 1 that year 2, well, for year 2, we need to get to 529,200. So we're going to pay it in that year. Okay. And then we have our last one. And then in year 3, what happens is we then sell the full amount. So we get a positive cash flow back. Okay, so then to answer our initial investment question, because that is part 1. I don't need to do that. I literally then just include this value, which is the investment in year 1, which then gives me a total investment of 5,772,500. Okay, so I'm going to pause there to see if there are any questions. Okay, so how do I calculate 1,575 on year 1? Okay, so for that one, the 1,571, I said the new machine limitation times the variable costs per unit. Okay, so I'll repeat. I will do that. I'll repeat how we get. So, Mark, your question says, do you not calculate the old machine variable cost? No, because look at what it says here in this paragraph. It says management has indicated that based on the historic trends of the company, the working capital requirement at the start of each year will equate to approximately 30% of total variable costs linked to the production of the new machine. Okay. Obviously, if they'd said to us linked to total production, I would then have to include the old machine. I'd have to say, these 195 units or this 120 plus the 75 and calculate it. So, I mean, it's a very valid question, but they've specified here it's only linked to the new machine. Okay, hope that answers your question. All right. Okay, so let me run through the working capital again. Okay, so with the working capital, because this question specifically asked you to calculate the working capital based on your variable costs, you have to work out, or the variable cost of the new machine, you have to work out how much the new machine is going to produce. So we know that our total units that we need is 195, 205, and 220. We know that the existing machine will be able to produce 120. So whatever's left over is for the new machine. So the 75, the 85, and the 100,000. Okay, but the new machine has a limitation. The new machine is only able to produce 80,000 units. So we have to factor that in. If we need 75, we'll be able to produce. If it needs 85, we can only produce 80. If it needs 100, we still can only produce 80. So we have to limit it. We then calculate the variable cost by taking the selling price times 25% and increase by inflation, because it's stated here that that is what we need to do. We then obviously increase for each year. Then to calculate the total variable cost, we say our new machine capacity times the variable cost per unit gives us a total amount. And then once we've done that, we calculate the working capital requirement, of which they said the working capital requirement is 30% of your total variable cost. So we're literally saying your total variable cost times 30% for each year. That's what we're doing. And then our increment will be the difference between the two. So in year 0, it's what we initially invest to get year 1's working capital. Year 1 will be the difference between year 1 and year 2. Year 2 will be the difference between year 3 and year 2. And then in year 3, we would sell our working capital because we're done with this project. And therefore, we would get the full money back of the full amount in year 3. Okay. Good. Okay. Okay, it now means that we have answered part 1. Part 1 is done. Or question 1.1. All right, so let's go to question 1.2. So question 1.2 is about calculate the income tax. Okay, so when we're calculating the income tax, it means that we have to calculate the total income before tax to then calculate what is required. Okay, so in order to do that, we first got to work out what our income before tax is, and then we have to calculate the tax deductions. Okay, so you can do this in 2 separate calculations, or you can do it in one. Really, really up to you. I know in the solution that I will share, it's been separated because I've separated the tax calc separately and the basically profit before tax amount or the income before tax amount. Okay. So income before tax. Okay, so I'll do it like that here as well. Because remember, if we were to do the full operating cash flow, we would need to work out what our net cash flows are before tax, take off the tax, and then calculate a net after tax amount. So that is what yeah, I'm going to explain it like that. Then we can separate tax principles versus income before tax principles. Okay. So to start off, obviously, with our income before tax, we have to calculate what our amounts are going to be. All right, so first things first, we're going to get our selling price per unit. We're then going to get our variable cost per unit. And then we're going to get our contribution per unit. Okay. We then have our total demand, or what we are going to do. And just to confirm, yeah, spelled variable wrong. Let's just fix that. Okay. We're then going to work out our units. So what are the total units? And then calculate that. All right. With this income before tax, okay, it hasn't really specified, but we need to limit it to the new machine only because this decision is about what the new machine can do for us. It's looking to increase its production, and we want to understand that impact. Normally it would actually specify here income after tax for Club Limited in relation to the new machine. It really needs to be quite specific here because if we had to do the income tax for the full Club, it means we have to take into account the machine that's already there. All right. So in this case, we're only going to do it for the new machine because that is what this decision is about. All right. Okay, so selling price, we know it's 80 Rand per unit, but we know that there is a inflationary adjustment, so it's going to be 80 . Okay, we know that our inflation is 10%. Oh, and we start in year 1 and not year 0 because year 0 is the initial investment. We always start in year 1. Okay. Okay, so we have 88 in our 88 for our first year. And then we do like what we did with our variable cost, where we go and we increase each year. Okay, so we're going to say here it is 88 times your 1.10 because that is the inflation that it said, right? So that will be our selling price. Obviously, it's rounding here. It's rounded. You can show decimals with pleasure. I've just decided to show it as rounded, which is fine, not an issue. Okay. Right, then our variable cost per unit. Okay, so we know that our variable cost per unit is basically what we had calculated before. So we're literally going to take what we had before. Okay. So this comes from the above line. Let me just highlight it so you can see where it comes from. Okay. Okay, which means now we can calculate our contribution per unit, which we know is selling price less our variable costs. Financial Management 2A principle that we are testing here. Okay, so that's our contribution per unit. Okay, now we need to say what our demand is. And we know it is basically what we had added here. Okay, which then gives us our total contribution. Oh. Right, next thing we have is our fixed overheads. Okay, here they said fixed overheads are anticipated to increase at 6% per annum each year from year 2 onwards, and fixed overheads is 220 in the first year. So we know that our fixed overheads is 220 in the first year, and that it will then increase by 6%. Okay, so let me also just show the calculation so you can see that. All right. And then we know here it's going to be the 233,200 increasing by 6% because inflation increases each year. Okay, which then gives us our income before tax. We have a working and income after tax. Okay. Okay, so for income before tax, it's obviously our total contribution minus our fixed overheads. And then the taxation we work out, and then income after tax will be the deduction of the two. All right, so now let's do our taxation calculation. All right, Now with our taxation calculation, we need to bring in what we already have. So we have our income. Okay, because that's the starting point. So we're going into tax mode now. When you do tax, we always start with the income before tax. We then will deduct all allowable deductions, as is said in taxation. The only allowable deduction here is our capital allowance. Okay, that is the only thing that's allowed here. It's a Section 12C allowance, which I'll show you where it's been documented in the question. So here it says SARS currently permits a Section 12C allowance. All right, so with your Section 12C allowance, basically we are saying it's 40% of the cost of our asset. We know that the cost of the asset, okay, and the total cost of our asset is the three items here. So it's the 4,500, the 300, and the 450. So it's the 5,250. Okay, so it's basically this value here, the one that we had calculated. %. Then in the next year, it's the 5 times 20%, because they said it's 20% in the next year, and then in the third year. Okay, we don't have a fourth year because this project is only for 3 years, so we don't have to worry about the fourth year's value. Okay, so that is our capital allowance that we've calculated. It then gives us our taxable income. What is our taxable income? It is the income for tax less our allowance. Okay, which then gives us our taxation at 28%. Okay, so we're saying that times 28%, okay, which gives us our tax value. Okay, now because they said to us that our tax is paid 1 year arrears, it means that when we calculate our income after tax, we have to factor that into account. So although this tax amount is for year 1, it's only paid in the next year. So this is 0 here. Okay. In year 2, we will pay that tax. We will pay then the following tax, and in year 3, we will have tax. Okay. Okay, so remember, arrears means we pay the following month, not the month in which the tax is calculated. It's very important. This is how you can be tricked. So to show you what is happening there. Okay, but then our income after tax we have to calculate is going to be our income before tax minus tax. And then that is our answer. All right. Any questions? Okay, so on Mustafa, I did actually go through it again. So the 2.6. Yeah, some stuff I did actually go through it again. I'm just summarizing it here for you. Oh, I see you got it. Okay, cool. I read that. Okay, so I'll redo from capital allowance to the screen was freezing, so I'll do that again. All right, so just to recap, question 1.2 is about the income after tax, or in other words, the net cash flow after tax. So we calculate what our income before tax is. We then need to calculate our tax amount, minus it from there, and get our income after tax, right? So when we are doing that, we have to do a tax calc. So I like to separate my tax calcs. I don't like to combine it like the textbook does because it gets very confusing, because this is a cash flow calculation. This is a tax calculation, and they are following two different concepts. All right, so if I go here to income before tax, I then have to minus the capital allowance from there. Capital allowance is the full cost of our asset, which we had calculated before. So remember, we had calculated it here before, times the 40%. 40% comes from our Section 12 allowance. Okay, we then do 20% because that's what it's asking us the next year, and then 20%. Our taxable income then becomes the difference between our income before tax and our capital allowance. And then our tax is taxed at 28%. Then with tax, remember, it's paid in arrears. So when we are doing our income after tax, although the tax is calculated in year 1, we only pay it in year 2. So it goes in year 2 column. Tax 2, we calculate it in year 2. So year 2's tax, we calculate in year 2, but we only pay in year 3. Year 3's tax, we calculate in year 3, but we only pay in year 4. So that's why it's like that. And that is how we then calculate our income after tax, or in other words, our net cash flow after tax. Okay, so I see someone's hand is up. Misa, your hand is up. Is there a question? Okay.
No.
Okay, no problems. Okay, you went down. Good. All right. Okay, so that completes our second question for today. We're going into our last question. So we're going to try very hard to finish that question in less than 20 minutes. So let's get on to that. I'm just going to pull up the question. All right, so please confirm that you can see the question.
Yeah.
Perfect, thank you. All right, so this question is 40 marks, which means it should take us 48 minutes. Okay, we've only got 20, so we're going to try and finish that in that time. And let's go to the required. So it says, calculate the payback period for the Johannesburg Academy and advise whether they should go ahead with this project. And then calculate the annualized net present values for both the Johannesburg and Durban academies, and advise the Management Board of Housing Limited as to which academy they should invest based on this method. So because of time, I'm only going to do Johannesburg for 1.2. My solution will have both, okay? But the principles are the same. So I'm only going to do Johannesburg, and then we'll do payback period for Johannesburg as well. Then you've got a comparative. All right. Okay, so let's read the question. It says, how's it limited considering investing in a new cricket academy in Johannesburg, where it will be used for both the national men's, ladies, and age group squads? The cricket nets will need to be repaired at the end of the second year at an expected cost of 200,000, and again at the end of the fourth year, with the cost expected to have increased by a further 50%. In year 6, the pitch on the main field and grass will need to be upgraded at an estimated cost of 1.25 million. And at the end of the 7th year, the facilities are expected to be sold to an educational group who are intending to develop both a high school and university academy in the area. And the estimated selling price is expected to be 6.5 million. Okay. All of the above cash flows have not been taken into account in the projections below. Okay, so these are all our cash flows, and we have to now adjust them for this. How's it limited as a cost of capital 11% for the Johannesburg Academy and a targeted payback period of 4.5 years. All right. When they talk about a targeted payback period, that is for you to compare when you calculate your payback period. So you can say, should I continue with it? If you have a payback period that's less, you're in a good space. If it's more, you should not take the project. Okay. This section at the bottom here is all about the Durban Academy. I'm going to leave that because we are not doing the Durban Academy now because we don't have the time. We're just going to focus on Johannesburg. All right. So the first thing that we need to do is we've got to do the payback period. Okay. But we need to understand, are the cash flows going to be even or uneven? So just to remind you, okay, so payback period is actually part of learning unit 6. So this is learning unit 6 and 7 question. Okay, remember we've got either an even stream of cash flows or a mixed stream of cash flows, one or the other. Okay, so how do we know this? We have to actually look at the question. So if we look at these cash flows, we can see they are not the same. Therefore, we are doing a mixed stream of cash flows, which means we have to use our other formula or the second formula. Okay. Okay, so how do we do that? Okay, so remind you, this formula that we're doing is this one. Payback period equal to year plus negative cash flow, etc., etc. Okay, so in order for us to apply this formula, we have to create a table. We have to create a table where we calculate our cumulative cash flows. Okay, so we must do that. Okay, so we're going to create a little table for us. Okay, perfect. Okay. So we always start with the first year, and then we obviously adjust as we go along. Okay, so we start with year 0. Then we've got year 1, year 2, year 3, year 4, etc. We've got till year 7. All right, so in year 1, we have an initial investment. Cool, and there's no adjustment there. So we're literally going to note it as a negative amount because we are paying it in the first year, right? So we have to show it as a negative value. Okay, which means our cumulative cash flow is 8750. Right, then in year one, we have 1.4. In terms of our paragraph here, there were no adjustments required for year one, so we don't have to worry about adjusting that, so that will stay the same. So we're literally going to go in here and we go 1,400. 1.4 million, I mean. Okay, and then we've got to make sure that we accumulate the cash flow. So we're saying this 875 plus the 1.4. Okay. Then in year two, it said that we had an expected cost of 200,000. So we have to factor that in now. Our cost. Okay, so we have to do a calculation. And then we accumulate our cash flow. Okay. Then we go to year three. There was no adjustment for year three, so the year cash flow stays as it is. Year four, we know that they had again an adjustment for year four. The cost expected to have increased by 50%. So in essence, it's going to be quite similar to what we had in year two, but we're just showing the increase of 50%. Oops, I must make sure I use the right cash flow because year four's cash flow is 3,200. Okay, much better. Good. All right, and then we accumulate the cash flows again. Okay, year five, there isn't anything, so we include the cash flow as is. And now we're starting to get positive cash flows. And then year six, our cash flow. Okay, it did say that in year six, the pitch on the main field and grass will need to be upgraded. So we have to include that as well. And it says at the end of the 7th year, expected to be sold, and the estimated selling price is 6,500. So we know in this last year that we have an extra amount that we're receiving. Right. Okay, now we can answer our question. We've created our table with the cumulative cash flow. So here is our formula that we have from before. So with the year, we literally go and include the year in which the last cash flow is negative. So we can see here, this is where our cumulative cash flow is negative. That's the last time it's negative. So that is in year 4. So we're literally going to go here and we're going to say 4 plus, and then we're saying our last negative cash flow, which was 250, and we divided by the next year's cash flow, which is 3,500. Okay. And so when we solve for it, we get 4.07. So the payback period is 4.07. All right. Any questions on that? Okay, looks like there's no questions. So last part of this question is to calculate the annualized net present value. We're just doing Johannesburg, okay? So with the annualized net present value, we've already calculated what all the cash flows are, okay, which is great. And then what we're
Claudia,
going to do, yes.
regards to your Muhammad also asked a question about 3,250,000.
Let me just check here. 3 million to 350. Thank you. Should double check.
I think in your formula you said next year's cumulative cash flow. It's supposed to be just the normal cash flow. He's taking the cumulative.
Let me just double check that. Thank you. Yes, it's just supposed to be next year's cash flow. Sorry, I need to fix that. Yeah. Cool. Okay, so I'll also just fix that. It's next year's cash flow. Thank you. Anyone else that has a question? I didn't see that. There we go. Let me just actually respond to this quickly. Perfect. All right. Now, 1.2. Right, so with 1.2, we have to calculate the formulas. Let me just go back to well, you can also use the calculator, but we're doing the annualized net present value. Yes, so annualized net present value. You can either do calculator method or we can literally just do the financial calculator method. I'm going to do the financial calculator because that's easier. So the first thing we have to do is we have to calculate the NPV, and then once we have the NPV, we can then calculate the payment amount. So let me bring that up for you quickly. Okay, so we know ANPV. Okay, so we remember we're just doing Johannesburg. So because we're doing NPV calculation, I'm just going to literally include all the cash flows. Remember, if you're doing a sharp calculator, you will need to rather say data, not cash flow, like on the HP. Just make sure that you are noting that. And there's 7 years of cash flows. Mhm. All right. Let me just update the 6, the 7. Good. All right. So we basically take our cash flow as we have in our as our table. So the cash flow, not the cumulative ones. Okay, so just double checking that we haven't forgotten one. Good. Okay. Then we need to include our interest, okay, which they told us was the 11%. So in the question they had said, so over here they had told us that our cost of capital is 11%. Okay, so then we calculate our NPV. Okay, and the NPV that you should obtain when you calculate it okay, once we've got the NPV, we can now do the NPV calculation. And I am doing the financial calculator method because that's just the quicker method. Okay, so with that, I'm literally going to say, what is my N? What is my interest? What is the present value, which will be in essence your NPV? And what is my PMT would be the answer. So my N for this question is 7 because I'm only doing Johannesburg and there's 7 years. My interest is the 11, so it's still the same, hasn't changed. My present value is the NPV that I got. And then if I do my PMT, and that is my annual net present value. Okay, obviously you could have done, remember there's other ways. You could have done table method. So to remind you, we could have done table method where you do a table, you just do the present value factor, or you could have done a formula. Both would have been acceptable. All right. Any questions? Anything else? Yeah, so your PV. Okay, so yeah, the question is there. Mustafa, sorry, I want to see who was asking the questions. Mustafa, yes. With your PV, yes, you can make that negative to get your PMT. Perfectly acceptable. Any other questions?
Claudia, what is your year 7 cash flow?
My year 7 is 8075.
Okay.
You see it there?
Yes, thanks.
Cool. Okay, if there's no other questions, that's all for today. Remember, I went through all the principles, but only applied the key ones. So there's quite a lot of other questions that could be asked. If you have any questions, you're more than welcome to reach out. I will share the slides with the corrections. I will share the question and the suggested solutions for the full questions. Like the last question, I only did part of it. You'll also get the Durban piece. I'll also share the financial calculator guides because a few people did not get that last time. So I'll make sure that's there, as well as formula sheet, as well as the recording. All of that will be shared. But that's it. Thank you, everybody.